So here's a puzzle for you. A company's core profit jumps 6%, but its stock drops 3%. Now, when that company is a market leader like ICICI Bank, you have to ask, what's really going on? Is this a genuine warning sign, or is the market just getting distracted by short-term noise? Well, in this deep dive, we're going to separate that signal from the static and figure out if the market's missing the bigger picture. And here it is, the paradox in black and white. On January 19th, 2026, the stock took a hit. But if you look at the bank's actual core engine, its operating profit, that grew by a really healthy 6%. This disconnect, this is what we're here to unpack. So what exactly spooked the market? And more importantly, were they right to be worried? Okay, this is the number that caused all the commotion. A headline net profit of 11,318 crore rupees. That's a 4% drop year on year. Now, for a blue chip bank like ICICI, where everyone expects steady, predictable growth, any kind of negative number is going to set off alarm bells. But, the headline rarely ever tells the whole story. And this right here gets to the absolute heart of it. That 4% tip, it wasn't because of bad loans or poor performance. You could call it an optical illusion. The entire drop can be explained by a one-time provision of about 1,283 crores that the RBI mandated. It was for a shortfall in priority sector lending. So if you just strip out that one-time non-business charge, the profit is actually positive. The key takeaway? The bank's operational engine is still running strong. All right, so now that we filtered out the noise, let's focus on the real signal. It's time to dig into the bull case for ICICI Bank, which really stands on three key pillars. And this isn't about just one good quarter. It's about a massive strategic transformation that's been happening for years. The first pillar, and you could argue it's the most critical, is leadership. The board extended CEO Sandeep Bakshi's term all the way to 2028. That is a huge vote of confidence. See, since he took over in 2018, he's brought in this culture of risk-calibrated profit, basically focusing on high-quality, sustainable earnings instead of just reckless growth. Knowing he's sticking around takes a massive piece of risk off the table. The architect is staying to see the job through. And this chart, well, it shows you the direct result of that leadership. The bank's gross non-performing assets, that's just a fancy term for bad loans, have plunged to a 10-year low of 1.53%. Even better, their net NPAs are at a tiny 0.37%. What this means is that ICICI has built a fortress of a balance sheet. It's probably the most resilient in the entire sector as we head into a new interest rate cycle. Pillar number 3 is technology. And honestly, ICICI has really established a clear lead here. Think of their tech strategy as a shield and a sword. The shield is stuff like Smart Lock, which protects us from all the rising digital fraud out there. The sword? That's their iMobile Pay app. It's an absolute powerhouse for bringing in new customers cheaply and keeping them happy. This digital dominance just widens their competitive advantage. Of course, no analysis is complete if we don't look at the other side of the coin. So let's put on our skeptical hats and talk about the bear case. We have to acknowledge the external challenges, the big macro headwinds, that could definitely cause some turbulence. This is the risk reality every investor needs to think about. So there are two main headwinds on the horizon. First up, the interest rate cycle is turning. The RBI just cut the repo rate to 5.25%. Now, since over half of ICICI's loans are linked to that rate, when it falls, the interest they earn also drops almost immediately. That can really squeeze their profit margins. Second, the regulators are watching. That provision we talked about is a reminder that the RBI is vigilant and we could easily see more of those compliance-related costs down the road. So, to quickly sum up the bear case, you've got three key risks. 1, a potential squeeze on their net interest margin, or NIM. 2, the ever-present threat of regulatory action that could lead to more of these one-off hits to profit. And 3, the competition for deposits right now is absolutely fierce, which might keep their own costs from falling as fast as their loan income. These are the headwinds to watch. Okay, so we've laid out the bull case, all the internal strengths, and we've laid out the bear case, all the external pressures. So how do we bring this all together? Well, the goal here isn't to give you a buy or sell call. It's to distill everything we've talked about into the one single factor you should be watching. So after all of that, what is the single most important factor to watch over the next 12 months? And here's the bottom line. The single most important factor to watch is the bank's net interest margin. Management has come out and said they expect stable NIMs. They're confident they can manage their funding costs even as lending rates fall. And their ability to actually deliver on that promise, that will be the ultimate test. It's the clearest signal of their underlying strength. The fundamental belief here is that ICICI Bank is a classic compounder, where those internal structural improvements, great leadership, a fortress balance sheet, and digital dominance are strong enough to weather any external cyclical storm. That's the signal to keep your eyes on.